Good morning, good day, afternoon, or evening to all listeners of this recorded webinar. My name is Pedro Russell. I'm the head of strategy and business development for Juno. We're a student lending negotiation company that works on behalf of our borrowers, to lower interest rates on their student loans. I'm here today to give a practical student loan advice for dentists webinar, and we hope that you find this information valuable. Walking through the agenda, and this is something that we as a team at Juno built ourselves specifically to try to help somebody who may not have the background on student lending or finance in general, understand the student loan process, interest and payments, how it all actually works, and why refinancing is so important. For some context, my background is in finance, so I majored in finance at Bentley University, worked in private wealth management for a few years before moving on to corporate strategy and then business development here at Juno. So more than happy to answer any questions. We also have a great team of advisors and experts at Juno. So there's always room for you to reach out to us directly. My email is pedro@joinjuno.com. And we also have hello@joinjuno.com for more general questions. So the agenda for today, we're going to walk through how student loans work, the mechanics of it. I'll break it down very simply to help you understand each component. We'll then move on to discuss what student loan refinancing is and how it helps you as a person and the impact it has on your life, and also some considerations when you think about making this decision. So student loans 101. Now, before your eyes glaze over, I'll give a really quick overview here. Student loan is money. At the end of the day, money issued in the form of credit, which is given by a lender to a borrower. The borrower agrees to pay back that lender at a predetermined time with interest. Interest is effectively the cost of borrowing that money, and you are assigned a specific percentage or interest rate that determines how expensive that loan actually is. The interest rate is based on how risky of a borrower you are through a process called underwriting. The lender will take a look at a bunch of different key information points in your loan application, including your credit history, debt to income ratios, and other criteria provided to them by you. In general terms, the riskier the borrower is, the higher the interest rate will be for that specific person. So what does that mean for you? Well, interest rate, that percentage, is not a direct percentage of the principal amount or the actual dollar figure that you're borrowing. And that's very important to know, is that if you're borrowing, say, $100 at a 4% interest rate over a period of 1 year, you will not actually end up paying $4 in interest as 4% of that $100. That total interest paid is calculated through a process called amortization. I'm not going to walk you through how an amortization table looks like, but essentially what you do is you take your interest rate, right, which is the percentage that you're paying over a year on the loan. And if you take the number of payments that you're paying in a specific year, which will always be 12, right? So you're paying 12 monthly payments onto that principal balance for a year. That interest rate is then divided by 12. So you have, let's say, 4% interest divided by 12 months. And then that number is multiplied by the amount that you borrowed. So 4% divided by 12 times that $100. And that is the interest that you will pay on that loan. So you might think, okay, how does this actually work or make sense? So let's break that down. When you are given a student loan, you pay back the same amount monthly. That doesn't change. So let's say on a $100 loan, you're paying down $10 per month, right? Or probably a lower amount, a higher amount, actually $12 per month or something like that. So that number doesn't change, but the interest that you pay does. So what happens is you have that $100, and then you have the interest that's calculated. So then that payment is broken down, that payment that you make every month is broken down by interest and principal. So first the interest comes out, and let's say out of that $12 that you pay per month, $8 of that is interest, right? So the remaining $4 of the $12 that you pay is taken out of your principal balance. So at the end of that month, you've paid, of the $100 that you owe, you've paid $8 on interest and $4 in principal, meaning that you still owe $96. Now you see how that can really be unfortunate, right? Because after 1 month, although you've paid $12, you actually have only reduced your loan balance by $4. So at the beginning of the next month, you owe $96. $96 times 4% divided by 12 gives you your new interest paid. And then that is deducted from the $12 first. And then the remaining amount applies to principal, which will be a little bit bigger than it was in the previous month. And that's how it works. And that's how the table works down. How does this impact your life? Well, for an average dentist who owes around $290,000, paying an average interest rate of 6.6% over a 20-year term, of that monthly payment, $2,200, you'll end up paying over $200,000 in interest. So you can see that, the way that amortization and the interest rates and the student loans are just structured is inherently designed for you to pay much more in interest than you would, if you were just working off of borrowing 6.6% of $290,000. So that's what makes student loan refinancing so important. So your risk profile as a borrower is not static. It changes over time and can improve depending on how much money you make, your ability to pay down your debt and improve your debt to income ratio, or any discrepancies that you've had in terms of your credit history as they age out and go away or become less recent in your credit history. This is extremely important to know as a professional who went to college, not just a dentist, but anybody, is because your profile as a borrower when you were in college borrowing that money is much riskier than your profile today as an active dentist or a dental professional working in a field that actually generating income. Your debt to income is likely improved. It most certainly is improved just because your income has gone up, and then as well as some of the debt kind of receding down. What does that mean? Well, it means that you don't have to pay the same amount on your student loan that you did beforehand. You could refinance your loan, which essentially means taking out a new loan with your new credit profile to pay down your old loan and your old credit profile. It doesn't happen automatically. You do have to reach out and apply for a new loan, but it's very easy process to do and do it, and it's completely free, which will save you, as you'll see, tens of thousands of dollars, right? Basically, to refinance your loans, you simply select a lender to borrow from, right? And you can check your rate during the application process before you actually commit to anything. And that lender will review you and your credit history and other underwriting criteria the same way that your previous lender had reviewed. What makes Juno different is we work on your behalf to negotiate with a group of lenders to find you the lowest rates on student loan refinancing. So as a partner to AAWD, we provide all of you with exclusive rates that are better than what you would be able to receive if you were to go directly to that lender outside of Juno. Let's talk brass tacks here, right? So this is why I do this presentation and why I think it's really important to understand how interest rates work. So if you take that original sum, right, you're borrowing $290,000. Your interest paid was 6.6%. That payment is around $2,200 over 20 years. As we mentioned before, you'll end up paying around $200,000 interest. After 1 year of paying down this principal loan, you will have around $283,000 remaining on your principal balance. That's despite having paid $2,200 a month for 12 months, which comes out to $26,000. So out of $26,000 that you've paid, you've actually only made $7,000 of a dent in your total interest, in reducing your total principal balance. Refinance as fast as possible if it makes sense for you, because this is what you get. If you refinance at a 3% interest rate, which by the way, we've seen interest rates even lower than this at Juno, depending on your credit profile, you have two options, right? You could either reduce your payment and keep the years that you want to pay your loan down, or you can keep your payment the same and drastically reduce the time it takes to pay down your loan. Option number one, if you're paying 3% interest on your new loan balance and you want to change your payment to lower it, you'll end up paying around $1,550, $1,600 a month over that 20-year period. Your total interest paid on that will be $89,000 as opposed to $213,000. So just by making that simple decision to refinance your loans, you end up saving over $100,000. I promise you, it is this good. It's not too good to be true. Your total savings on that is $124K. If you want to pay your loan down even faster, if you're comfortable with the amount that you're paying out per month, you can shave off, 10 and a half years off your student loan payments, and end up paying about $100 and saving $150,000. So it's not really a complete no-brainer here. There are some things to consider, especially when it comes to public versus private loans. Public loans come with additional features or benefits that private loans don't have, being forbearance, which means the ability to forego paying student loans for a period of time if you return to school or if you come under some financial hardship. Income-driven repayment programs, which means that you pay down your student loan based on the amount of money that you're making, and public student loan forgiveness, which is if you work at in a public hospital or other qualifying jobs that are lower income than in the private sector, you may be eligible for some loan forgiveness. Private loans are not eligible for any of these features. It's because they are the debt facility, the lender that you borrow from is for-profit institution that doesn't work off of like the same regulations as the government is able to. And so if you transfer your public loan to a private loan, the risk is you eliminate these benefits and there's no sort of other options for paying down the loans available to you. So what else should you consider before refinancing your student loans? Well, there's the student loan forbearance that was just recently announced. So on December 22nd, President Joe Biden announced that the administration would be extending the pause on student loan payments for public loans until May 1st, 2022. That means that for any public loan, you're not required to make any payments from now until May 1st. Our perspective on this is this will not go on forever. The reason is that what we see is that Democrats do not believe that we have the authority to actually cancel student debt. Even if President Joe Biden were to cancel, it would almost certainly be challenged all the way up to a 6-3 conservative majority Supreme Court. Again, this is just our opinion, not fact, but is our belief that student loan forbearance will not move into a mass student loan forgiveness. So where do you go from here? If you're interested in learning more about refinancing or figuring out if that makes sense for you, there's a little bit of homework. So who are your loans with? Check your email and see who is actually servicing the loans and who are you making direct payments to. Look at your total amount owed. It might actually be higher than the principal balance because you've been accumulating interest while you're in dental school. What interest rate are you paying? If you're paying anything above 4%, there's savings to be had right now. And also looking at your budget. What are you paying now? What are you capable of paying in the future? Identifying if refinancing makes sense is an addition to these questions, right? So, once you find out what you're paying now, think about, can you afford to be paying a different amount? And are you comfortable with your financial situation to convert some public loans to private? Again, we're happy to be a resource here for you. There's we don't want anyone to be left out on an island. So either contact us through AAWD or reach out to us directly. But when you're ready, make changes, refinance your loans. We hope you do it through us, but we certainly do want you to rate shop. Talk to a financial advisor and make sure that the refinancing fits within your budget. And at the end of the day, if there's one thing that you take from this presentation, we ask that you look at your student loans as an opportunity to attack them, not ignore them. Not doing anything is exactly what the lenders want you to do. They want you to ignore them, pay your interest rate, not even really know what you're paying. I've had a friend, this is a story I tell everyone, had $150,000 in student loans, hadn't refinanced in over 6 years. We recently refinanced her with Juno at a 2.6% interest rate, down from her average of like 7%. And she's going to end up saving $75,000. And that entire process took about 20 minutes. So you're not alone in this. We're more than happy to help. So, please, if there are any questions, don't hesitate to ask. I'd be happy to be that resource for you. Thank you very much. I hope this was a helpful presentation. I know we tried to keep this quick, really just so that you could understand just the basics, but happy to add any context or value if you reach out to me directly. Thank you very much. Bye-bye.